One Up on Wall Street by Peter Lynch. Picture this, October 1987. One of history's greatest investors is finally taking a rare vacation in Ireland, ready to enjoy some legendary golf courses. On Monday, October 19th, he's playing a full round at the stunning Killeen course in Killarney. After packing up his clubs, he and his wife drive out to the gorgeous Dingle Peninsula and check into a cozy hotel. And then? He doesn't leave his room for the entire afternoon. Why? Because back home in America, Wall Street is having a total meltdown. That Monday, the stock market crashed 508 points, the biggest single-day drop in history. In mere hours, $2 billion, yes, with a B, had vanished from the mutual fund he managed. 1 million people who trusted him with their life savings were watching it all disappear before their eyes. So no, he wasn't taking a nap. He was glued to the phone, thousands of miles from his office, trying to navigate what felt like the financial apocalypse. Later, he admitted he genuinely couldn't tell if the world was ending or just Wall Street was going under. That man was Peter Lynch. The fund? Fidelity Magellan, which became the best-performing mutual fund on the planet under his watch. His story of surviving that crisis, and so many others, is the stuff of legend. But here's the real kicker. He doesn't think he's some financial wizard with superpowers. He thinks you can do what he did. Peter Lynch wrote One Up on Wall Street, which has sold over 1 million copies. It's not some dense textbook that'll put you to sleep. It's a straightforward, powerful guide built on one radical idea. Regular people, with just a bit of homework, can pick winning stocks as well as, or even better than, Wall Street's finest. Today, I'm breaking down the timeless wisdom from that book. By the end, you'll understand the secret advantage you already have, one that Wall Street pros would absolutely kill for. You'll learn how to spot game-changing investments at your local mall, in your own home, or from products you use every day. No complicated formulas, no risky gambles, just opening your eyes to opportunities hiding in plain sight. If you've ever thought investing was too scary, too complex, or just not for you, buckle up. Peter Lynch is about to flip that script. And it starts with one simple revolutionary idea. Stop listening to the professionals. Wait, what? Stop listening to professionals? That sounds nuts, right? When you hire a plumber, you listen. When you see a doctor, you listen. But Lynch insists investing is different. In this world, the so-called smart money isn't always so smart. And the dumb money, Wall Street's charming term for regular folks like us, is only dumb when it follows the smart money. After 20 years on Wall Street, Lynch became convinced of something amazing. Any normal person, using just a fraction of their brainpower, can outperform the average expert. Why? Because in your daily life you have a powerful advantage. He calls it the amateur's edge. So what is this edge? It's the power of your own first-hand experience. Think about it. Long before Wall Street analysts type up their fancy reports, you're already out there interacting with hundreds of companies every single day. Lynch shares a great story about one of his best investments ever. It didn't come from some secret memo or boardroom meeting. It came from his wife, Carolyn. In the early 1970s, she came home from the grocery store buzzing about a new product. Women's pantyhose packaged in colorful plastic eggs, displayed on a metal rack right by the checkout. The brand was Legs. Lynch was a textile analyst at the time. He knew all about profit margins and supply chains. But his wife, just by being a regular shopper, had stumbled onto a gold mine. She didn't need a business degree to see the genius. Super convenient. You could grab a pair while buying milk and bread. No special trip to a department store needed. Plus, the product was actually great, durable, and fit well. Millions of women saw this. Store clerks saw it. Husbands saw those plastic eggs piling up at home. Anyone could have walked into any supermarket in America and witnessed this runaway success. From there, it's a simple step to discover that Legs was made by Hanes, and that Hanes was a stock you could buy. Lynch did his homework, confirmed the story was as good as it looked, and the stock became what he calls a six-bagger. It went up 6 times in value before the company got bought out. He's convinced it would have been a 50-bagger if it had stayed independent. And here's the kicker. You didn't need to be some early genius. You could have bought Hanes in the first, second, or even third year after Legs went national, and you still would have at least tripled your money. But how many people actually did? Lynch tells this hilarious and painfully accurate story about a fictional couple, Harry and Henrietta Houndstooth. Harry is the family's designated investor. He reads the Wall Street Journal religiously, subscribes to pricey newsletters, and hunts for exciting high-tech tips. He's the guy who hears about Winchester disk drives and, without knowing a disk drive from a dinner plate, convinces himself he's done his due diligence and throws in the family savings. Meanwhile, Henrietta comes home from the mall raving about this amazing new clothing store called The Limited. The place is mobbed. The clothes are fantastic. The prices are incredible. She's genuinely excited. But when she tells Harry, he just grumbles about her wasting money while he's busy trying to make it. You can probably guess how this ends. Winchester Disk Drives has a rough quarter, the stock tanks, and Harry sells at a loss, congratulating himself for cutting his losses. Meanwhile, The Limited, the store Henrietta discovered, quietly becomes one of the decade's greatest investments, a genuine 10-bagger. A 10-bagger is Wall Street slang for a stock that returns 10 times your money. Invest $1,000, walk away with $10,000. It's the home run of investing. And Lynch's whole philosophy is that these 10-baggers aren't hiding in some obscure lab somewhere. They're often right in front of us, in companies we already know and understand. He gives tons of examples. Dunkin' Donuts. Lynch loved the coffee. If you'd invested just $270 in 1982, about what you might spend on donuts in a year, it would have been worth over $1,500 just 4 years later. Subaru. In 1977, you could buy the stock for the equivalent of $2 a share. By 1986, it hit $312. That's a 156-bagger. If you'd invested the price of a car, say $400, into the stock instead of buying the actual car, you would have made over $1 million. Taco Bell. Lynch was impressed with their burritos on a California trip. The stock soared even through recessions. Apple Computer. Kids had them at home. Then offices started buying them. The signs were everywhere. If you'd put $2,000 into Apple stock in 1982, the same week you bought your first Apple computer, those shares would have been worth nearly $12,000 5 years later, enough for a year of college. This is the amateur's edge, the power of common knowledge. The professionals on Wall Street, the so-called experts, are often the last to know. Lynch calls this street lag. Why does it happen? Well, think about a professional fund manager's life. First, they're completely overwhelmed. Lynch himself followed 400 stocks at Magellan. Most managers cover hundreds. They don't have time to hang out at the mall observing what people actually buy. Second, they live in a bubble. They all read the same reports, talk to the same economists, follow the same herd. It's safer to be wrong in a crowd than wrong alone. There's an old Wall Street saying, "You'll never lose your job losing your client's money" in IBM. If you buy a huge, well-known company and it tanks, everyone shrugs and says, "What happened to IBM?" But if you buy some obscure company like La Quinta Motor Inns and it goes down, they stare at you and ask, "What's wrong with you?" This fear keeps them glued to a pre-approved list of big, boring, well-known companies. They often can't or won't invest in a small, exciting company until it's already been discovered by dozens of other analysts and its stock has already jumped tenfold. By the time the experts are recommending the limited, Henrietta has already moved on to the next great store. This is your opening. The amateur investor isn't burdened by these constraints. You can invest in a company with a silly name like Pep Boys, Manny, Mo, and Jack. A real company, and a massive winner. A professional might be too embarrassed to recommend it. You're free to follow your own research wherever it leads. But, and Lynch hammers this point home repeatedly, liking a store or product is not a reason to buy the stock. It's a reason to start your research. It's a lead. The first chapter of a story you need to investigate thoroughly. Finding a promising company is only step one. Next comes the homework. This is where most people bail out, but Lynch promises it's not nearly as hard as you think. Before you even start looking at companies, though, he says you need to look in the mirror. He calls it the mirror test, and it involves asking yourself 3 simple questions. First, do I own a house? Lynch believes that before investing $1 in stocks, you should consider buying a home. He calls a house a wonderfully rigged investment. Banks will lend you 80% of the money, giving you incredible leverage. Put 20% down on a $100,000 house, and if its value goes up just 5%, you've made a 25% return on your investment. Plus, the mortgage interest is tax deductible. It's a hedge against inflation, and obviously it keeps the rain off your head. People spend months researching a house, checking the foundation, roof, schools, neighborhood. But then, they'll throw their life savings into a stock they heard about on the bus. Lynch's point is simple. Apply the same diligence you'd use buying a house to buying a stock. Second question, do I need this money? This is about your financial situation. If you'll need the money in a year or two for college tuition or a down payment, don't put it in the stock market. Stocks are predictable over 10 or 20 years, but short-term? Anyone's guess. Even the safest blue-chip stock can get cut in half and stay there for years. The rule is simple and absolute. Only invest what you could afford to lose without it affecting your daily life. This isn't gambling money. It's money you can let grow patiently over time. And the third most crucial question, do I have the personal qualities that will bring me success in stocks? What are these qualities? It's not about genius-level IQ. In fact, Lynch thinks true geniuses often get tripped up by complexity. The math you need is 4th-grade stuff. The real qualities are things like patience, self-reliance, common sense, tolerance for pain, open-mindedness, and humility. Most importantly, it's about having the stomach to ignore your gut feelings and the general panic. The stock market is volatile. It goes up, it goes down. Your favorite stock that you bought for $20 might drop to $12 for no good reason. Human instinct screams to panic and sell. But if you've done your homework and the company's story is still solid, the winners are the ones who hold on, or even buy more. This is why Lynch says you should never ever ask, is this a good market? He says the market is irrelevant. Predicting the short-term direction is a fool's game. Thousands of experts try, and they consistently fail. Don't worry about the market. Don't worry about the economy. Don't worry about the talking heads on TV. Instead, invest in companies, not the stock market. If you own good companies that continue growing their earnings, you'll do well over the long run. He points out that since World War II, corporate profits in America are up 55-fold, and the stock market is up 60-fold. 4 wars, 9 recessions, 8 presidents. None of it changed that fundamental truth. So once you've passed the mirror test, and you're ready to focus on companies, where do you start? This is where Lynch gives us one of his most powerful tools, the 6 categories. Every stock you'll ever encounter fits into one of 6 simple categories. Understanding which category a stock belongs to is your first step in knowing what to expect. Let's walk through them. Category 1, the slow growers. These are large, aging companies growing just slightly faster than the overall economy. Think big electric utility companies. They used to be fast growers, but their industry matured. They're not going anywhere fast, and neither will their stock prices. Lynch generally avoids these unless they pay a very reliable dividend. Category 2, the stalwarts. These are giant blue-chip companies like Coca-Cola, Bristol-Myers, or Procter & Gamble. They won't give you a 10-bagger, but they're not going bankrupt either. They grow maybe 10 to 12% a year. Lynch likes keeping some of these in his portfolio. They're like dependable friends in a crisis. When the market panics, people flock to these trusted names. He says you can make a solid 30 to 50% on a stalwart, then sell and rotate into another stalwart that hasn't moved up yet. Category 3, the fast growers. This is Lynch's favorite category, and where you'll find the 10-baggers. These are small, aggressive new companies, growing at 20 to 25% a year. Think Young Walmart, Taco Bell, or The Gap. They've found a successful formula in one location and are now rapidly expanding nationwide. This is the most exciting and also risky category. These companies can flame out, but the rewards for picking a winner are enormous. Category 4, the cyclicals. These companies, sales and profits rise and fall in regular, if not entirely predictable, cycles. Think airlines, auto companies, steel, chemicals. When the economy's booming, people buy cars and take vacations, and these stocks soar. But when recession hits, their profits vanish, and their stocks can get absolutely crushed, losing 80% or more of their value. Lynch says timing is everything. With cyclicals, buying at the wrong point in the cycle is a recipe for disaster. The best time to get interested is when the industry's been in a slump for a few years and everyone's given up on it. Category 5, the turnarounds. These are companies that have been battered, bruised, and left for dead. They might be on the brink of bankruptcy. Lynch calls them the no growers. A great example is Chrysler in the early 1980s. The company was a mess. The stock had collapsed, but they got a government loan, restructured, cut costs, and came out with popular new cars, like the minivan. The stock went up 15-fold. Turnarounds are high risk, but the rewards can be spectacular. You can lose your entire investment, but if you're right, you can make a fortune. And finally, Category 6, the asset plays. These are companies sitting on something valuable that the market has overlooked. Could be cash, real estate, oil, even a patent. The trick is knowing what the assets are really worth. Lynch tells this great story about Pebble Beach, the famous golf course. The company's stock was selling at a price that valued the entire company, including the golf course, hotel, and 700 acres of prime California coastline, at just $25 million. A few years later, it got bought out for $72 million, and the very next day, the new owner sold off just one small part, a gravel pit, for $30 million. The gravel pit alone was worth more than what investors had paid for the whole company just a few years earlier. That's a classic asset play. So once you've placed a company into one of these 6 categories, you know what kind of story you're looking for. The next step is what Lynch calls the 2-minute drill. Before buying any stock, he says you should be able to give a 2-minute explanation of why you're interested. If you can't summarize the story in a couple minutes, in simple language a 5th grader could understand, you haven't done enough research. What should be in this story? You're answering the question, What's going to make this stock go up? For a fast grower like La Quinta, the story is, they offer Holiday Inn quality rooms at a 30% discount by cutting out fancy lobbies and restaurants that business travelers don't need anyway. They have a clear niche, they're expanding at 20% a year, and they have tons of room to grow before running out of places to build. For a cyclical like Ford, the auto industry's been in a slump for 3 years, but sales are picking up. Ford has slashed costs dramatically, and their new cars are super popular. Earnings are about to rebound big time. For a turnaround like Chrysler, the company was nearly bankrupt, but they've paid off debt, closed inefficient plants, and the new minivan is a huge hit. They're profitable again, and the stock is still dirt cheap. Once you have this basic story, you fill in the details with research. And again, Lynch insists this isn't complicated. First, talk to your broker. But don't just beg for hot tips. Make them work for you. Ask for the analyst's report. Ask for the company's financial statements. Ask specific questions about the story you're developing. Second, call the company. Every public company has an investor relations department. Their literal job is answering questions from shareholders. You can call and ask about expansion plans, debt levels, competition. You'd be amazed what you can learn. Lynch says he finds something unexpected and useful in about 1 out of every 10 calls. Third, read the reports. Annual reports can seem intimidating, but Lynch has a shortcut. He flips right past the glossy photos and chairman's letter and goes straight to the financial statements in the back. He's hunting for a few key numbers to check the company's health. And this brings us to the famous numbers. You don't need to be an accountant, but a few simple concepts can tell you almost everything about whether a stock is a bargain or a ripoff. The most famous is the PE ratio, price-to-earnings ratio. You'll see it listed next to every stock in the newspaper or finance website. It sounds technical, but it's incredibly simple. It's the stock price divided by the company's annual earnings per share. Think of it as the number of years it would take the company to earn back the price you paid. Assuming earnings stay the same, a stock with a PE of 10 takes 10 years. A PE of 20 takes 20 years. So is a lower PE always better? Not necessarily. A slow-growing utility might have a PE of 8, while a fast-growing tech company might have a PE of 30. You can't compare apples and oranges. But Lynch gives us a brilliant rule of thumb. He says for a company to be fairly priced, its PE ratio should roughly equal its growth rate. Let me repeat that because it's one of the most valuable ideas in the entire book. A company's PE ratio should be about the same as its annual earnings growth rate. So if a company's growing earnings by 15% a year, it should have a PE of about 15. If you can buy it at a PE of 10, you've found a bargain. If its PE is 30, it's probably overpriced. A stock with a 20% growth rate and a PE of 10 is a fantastic opportunity. A stock with 10% growth and a PE of 20 is risky and headed for a fall. This simple comparison is one of the most effective tools an investor has. What other numbers matter? The cash position. Lynch loves companies with lots of cash and little debt. He tells this great story about Ford. In late 1987, after the market crash, Ford stock was selling for $38 a share. But when he looked at their balance sheet, he saw the company had so much cash, after subtracting all long-term debt, that there was $16.30 in net cash for every share. Think about that. When you bought a share for $38, you instantly got $16.30 in cash. So you were really only paying about $22 for the entire car-making business, one of the biggest and best in the world. This cash provided a huge margin of safety. No matter what happened, Ford wasn't going under. The debt factor. The opposite of a strong cash position is a mountain of debt. Lynch says debt is what kills companies in a crisis. He pays close attention to a company's debt-to-equity ratio, which you can find on any financial summary. A healthy company might have 25% debt and 75% equity. A struggling one might have 80% debt. For a turnaround candidate, this is the most critical number to check. Book value. This is the theoretical value of a company if it got liquidated tomorrow. But Lynch warns that book value can be very misleading. A textile company might claim its old looms are worth millions on the books, but at auction, they might only fetch scrap metal prices. However, sometimes book value hides incredible assets. A railroad company might own millions of acres of land carried on the books at 1800s cost, but worth billions today. This is where you find asset plays. And finally, of course, there are the earnings. This is the bottom line. Literally, it's the profit a company makes. Lynch says over the long term, a stock's price will always follow the path of its earnings. If earnings go up, the stock will eventually follow. If earnings go down, the stock goes down. It's the single most important factor. He shows chart after chart where the earnings line and stock price line move in perfect sync. A company's stock price can get ahead of its earnings for a while, driven by hype and speculation, but it always comes back to reality. And this brings us full circle. The entire process Lynch lays out is a journey to understand a company's story, backed by a few simple numbers. You start with an edge, something you've observed in your own life. You classify the company into one of the 6 categories to understand what kind of story you're looking for. You do your 2-minute drill. You do a bit of homework to check the P/E ratio, debt, and earnings. And then you invest. And you wait. You don't panic when the market drops. You don't get greedy when the stock inches up a bit. You hold on as long as the fundamental story of the company is still intact. And if it is, you'll be amazed at the results in a few years. This is the path to finding a 10-bagger. It's not get rich quick. It's get rich slowly, get rich surely. And it's available to anyone willing to open their eyes, trust their own judgment, and do just a little bit of work. When you step back and look at One Up on Wall Street, it's wild to think it was written decades ago. In our world of meme stocks, cryptocurrency, and day trading apps that turn investing into a video game, Peter Lynch's advice feels more radical and necessary than ever. His core idea is almost an act of rebellion against the noise of modern finance. He's telling us to turn off the TV, ignore the headlines, and look at the world around us. The most valuable financial information isn't locked in some Wall Street supercomputer. It's in the checkout line at the grocery store, in the new software your company adopted, or in the packed restaurant that just opened in your town. What I find so powerful about this book is that it's not just about investing. It's a lesson in how we know what we know. It's a call to trust our own direct experience over the second-hand opinions of so-called experts. In a world drowning in information where everyone's shouting, Lynch's wisdom is a quiet voice reminding us to observe, think for ourselves, and have the courage of our own well-researched convictions. The lessons are profound. Don't invest in things you don't understand. Don't try to predict the unpredictable. And above all, have patience. Investing isn't a sprint. It's a marathon. The real money isn't made in trading. It's made in owning. Owning a piece of a great business and holding on as it grows, year after year. So how can you start applying this wisdom right now in your own life? It's simpler than you think. Here are 3 small actions you can take today. First, start your Edge Journal. For the next week, grab a small notebook or open a note on your phone. Every time you interact with a company, Write it down. Your toothpaste brand. The coffee shop you stop at. The software you use for school. The delivery company that brings packages to your door. Don't judge. Just observe. At the end of the week, you'll have a list of dozens of companies you have a direct personal connection with. This is your personal hunting ground for ideas. Second, do one 2-minute drill. Pick just one company from your journal. Maybe it's a clothing brand you love, or a fast food chain that's always packed. Now try to tell its story. In just a couple sentences, why do you think it's successful? Is it a fast grower, expanding everywhere? Is it a stalwart, a trusted brand that's been around forever? Just trying to articulate this will clarify your thinking in a powerful way. And third, find the PE ratio. Look up the stock symbol for that one company you chose. You can do it on any free finance website. Find its PE ratio. Then try to find its earnings growth rate. Many sites list this too. Is the PE higher or lower than the growth rate? This simple 5-minute exercise will make the most important valuation tool in Lynch's playbook feel real and accessible. The journey of 1,000 miles begins with a single step, and the journey to becoming a successful investor doesn't begin on Wall Street. It begins with you, with your unique perspective, your curiosity, and your willingness to learn. That was a summary of One Up on Wall Street by Peter Lynch. We've touched on the big ideas today, but a summary is like looking at a postcard of the Grand Canyon. The real experience, the awe, comes from standing on the edge yourself. The true magic of this book is in the stories, the details, and the way Lynch's humble, common-sense voice makes you feel like you have a wise and trusted mentor by your side. This summary is a map, but the treasure is in the book itself. If anything we've discussed has sparked your interest, I encourage you to grab a copy. Reading it isn't just an education, it's an empowerment. The link to the book is in the description. Also, if this journey through Peter Lynch's wisdom has been valuable to you, please consider hitting that subscribe button and joining our community. We explore a new life-changing book from the billionaire's bookshelf every week, and I'd be honored to have you with us as we continue to learn and grow together.